Yes, hello guys, that is TGR speaking at the founder of Nas100. As you know, I don't trade the indices. So here the trade is Nas100. As you always see that my focus is on the indices. So it's gonna do the same thing as you stage. So basically what you see here is that you see the yesterday structure that I analyzed. So now you can see the time is 15 o'clock, which is the session opening. There's a difference between when the session opens and after the session opened. Okay, there is basically the session overlapping, meaning the London session overlaps with the US session, but the session opening begins at 3:30. So when you trade, let's say you trade euro USD during the session overlapping, where is 1 p.m. and 2 p.m. By 1 p.m., that is when the London session overlaps with the US session at 2 p.m. That is when actually, let me not expose these things because of, like, I know most of you going to be confused, said what this guy is talking about. Okay, I don't want to explain this, but in a detailed view, that is a session overlapping. So the London session overlaps with the US session at 1 p.m. to 2 p.m. That is when the session overlaps. That's when there's a high momentum of market movement. Okay, but when you trade Nasdaq, you realize that most of the times the market doesn't move at the session overlapping. It will move on the session opening at 3:30. So at 3:30, that is the session overlapping at South African time, which is 3:30 GMT plus 2. So, and that is when the market has high volatility of movement. So what causes volatility in the market? Volatility, it is being caused by liquidity. So what generates the liquidity? Liquidity, it is being generated by the algorithms. So what is an order flow? The order flow is actually, let me make it easy. The order flow, actually, it is the quantity of an asset or the volume of an asset. How 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 actually can it move in a certain direction because of that liquidity? So meaning right now is NFP. NFP doesn't fall inside this. It falls inside this. So meaning that during the NFP session, just like at this point, the movement that will move at this point at 2:30, it cannot be bigger than the movement that is going to happen at 16 o'clock. At 16 o'clock, from 3:30 to 16 o'clock, which is the continuation session, meaning that at 2:30, the movement is going to be continuation movement due to NFP and due to the session opening, meaning at 2:30, you are trading a session NFP. And when the session opens at 3:30, meaning that now you trade the real volume of the session. But during 2:30, you are trading the overlapping session NFP, the overlapping session CPI, PPI. All those things, they fall under the session overlapping. I'm gonna give you the secret. As right now, as you can see, this line, this candlestick touched the session opening. Meaning now in this line, we focus on the high volatility session. And this point, we focus on the low volatility session. So meaning correct, there's a liquidity, there's a liquidity. So what happens during these times where like the volume is too less, where like the volume is too high? Meaning when the volume is too low, during this phase, there's a synthetic liquidity. So this synthetic liquidity is being generated by the algorithm in order to trigger the high volatility session, which is the one that's gonna come in this point. Sometimes where like you can say this point that the market just moved smoothly, aggressively going up. Why? Because that's the moment when the session during these times, it is the Asian, it is the London, and the London overlaps with the US session. So both of these two sessions, they have a low volume in terms of nested. But when you check dexterity after the session overlapping with the US, the dexterity is going to be having a less volume, meaning it is not really, I can't say this, okay? But right now, as you can see, what happens in terms of the sessions, what happens in terms of the liquidation, what happens in terms of the order flow. So in terms of the order flow is being positioned at the area where most of the traders are willing to buy, but the order flow is situated above your stop loss. Why? Because the algorithm cannot trigger the order flow exactly where you put your sell limit or your buy limit, but it can trigger the order flow above your stop loss and above your buy limit or your sell limit. Why am I saying this? Because of the market cannot create a high volatility spike, because once the market just actually buy exactly just like at this point, meaning it bought where you bought the market, meaning that now, meaning this meaning there was a order flow at this point, exactly at that point, but not exactly at that point, but the order flow was below, above this line. So meaning now the market must come down a bit to trigger all of those orders that are associated at this point. You understand me? Something like that. So now we know when these orders are associated at this demand, the market must go below at least to mitigate all of these orders. Easy as that. So right now, as you can see, the market has closed above this consolidation trap. Consolidation, the purpose of the consolidation is to create a certain liquidity of the traders, a certain liquidation trap. You understand me? Because of the moment when you are in the trade, the market is going to go the opposite way. Because I say to you, if these orders at this point, they will sell the market, why not the market go up first? So if then the market just sells exactly at this point, meaning there was an order flow at this candlestick, not above this. Okay, meaning there was an order flow at what? At this candlestick. Hence, this why this candlestick went up. Meaning they triggered this order flow, then the market is going to sell exactly at this point. But why not put this order flow at this point if I'm the institutional trader? Because I want to buy or I want to sell at a good level where I cannot cause a market spike. Hence, that is why the market now closed just like that. You know, forex patterns. So now the market goes up again to this area of sell liquidity where there is an order flow. Remember, the market maker can trigger the order flow using the spreads, using this kind of things. Where now you cannot trigger the sell limit. Yes, on your side, the sell limit can be triggered by the broker spreads, where during the extended hours of the market, the spread becomes high. That's when the broker triggers your stop loss. The same way as the market maker, the spreads can trigger their order flow. So right now, let me not waste time to say, now once the market is at this point, we know inside this line, there's high volatility chance of the market moving down or up. But in this point, that high chance of the market moving up, it depends on what those who have the strategy, they will tell you. So let me pause and show these volumes, okay? You can see when I plug this volume, it shows you that inside this the volume is too high, the volume is too low, inside this the volume is too high, inside this the volume is too low. Look at right now what's gonna happen inside this. The volume is gonna be high, meaning there's a shift in terms of the volume, which is caused by the session opening, and that session it has a high volatility. Easy. Akere. It means now when since you don't understand what causes this high volatility in this point, you don't understand. It caused by something else which is very, very important to you. That's why most of you be like, I'm telling you, like some of you, you blow. You blow because of you don't understand certain types of liquidities in the market. There's an algorithm liquidity. The algorithm is the market maker. It has been programmed in a way that it knows the levels because it creates the levels. It mitigates the level. Something like that, guys. Okay? Because me, I'm just a market maker. I'm just sitting there monitoring the trades. I monitor the trades. I manage my funds. But who's doing this? The algorithm. So now you come here with your mindset, say, this is what the market is doing. You're going to blow. Why are you blowing? You blow because of you understand what is going on, but you don't understand what is the purpose of this algorithm in the forex market. Everything, even in cryptos, this guys like when you trade the memes, is it the meme, the meme coins where like the volume goes to zero? Is it the rug pull, something like that, where like they say the meme coin has went to zero. They say the Kanye West coin has been published, meaning the coin has been designed. They designed only the structure. You understand me? They only designed the structure. So they cashed out, meaning the institution order flow has been cashed out, meaning now the coin went from 23,000 at this point. Since we know we've made money, this order is still in profit. Now let's close this order. Once we close this order, meaning we sell the market back to this point. Now this order becomes in profit, meaning now in this point, from this point to this point, you made 2 million. From this point to this point, you've made 2 million, meaning you've made 4 million. It begins to zero. How much is the equity? 4 million. 4 million equity can push the market up to mitigate this high and to continue even further. That's why Bitcoin is doing this. It keeps on creating certain liquidation patterns. They mitigate, they continue. They mitigate, they continue. When you come with your own ideas, oh no, my guy, Bitcoin can go to zero because of the order that bought the market at $0 share price is still in profit even right now. That order can be mitigated by the exactly order at the current high. That order at the current high can mitigate that $0 share price that bought the market to how many points? Maybe 300 points, 300,000 points, something like that. It doesn't matter. That's why they say supply and demand. The demand exists supply. Now the market is at the retail supply. The market needs to sell back to the demand. The market was at the supply, demand. The market bought, the market at the supply, the market sold. Break the demand, the market comes to this demand. Easy as that. Don't use trend lines. Especially on a stake, don't use trend lines. Because I know the reason why I say don't use trend lines, because Nasdaq is combined with two liquidities and two order flows. The first order flow is of the 15 and the second order flow is of the 7, meaning all of these order flows, they are combined. They will give you shift in terms of the volumes, where like look at this candlestick, they are not equal. Why are they not equal? Because of the other one goes below, the other one goes above, like something like this. The below when you draw the trend line, let's draw the trend line. I say I want to draw this trend line. It fits. This line fits, but look at what the volume is doing. This line fits, but look at what the volume is doing. Look at what the volume is doing at this point. From this point, look at what the volume is doing. This is what the volume is doing. You see, look at this. Look at what the volume is doing. Now the volume goes up, the volume closes. That is when the market closes, the market reset, the volume drops. Again, the volume increases at this point. Let's say again, the volume now drops. Now the volume rise. Again, what does the volume do? The volume drops. The volume drops. Here's the volume dropping. Where does it drop? It drops with this at this point. This is where the volume dropped. This is where the volume dropped at this point. This is where the volume dropped. That is the candlestick that the volume dropped. Now the volume dropped, but the market rise. At this point, the volume dropped, but the market rise. In this point, the volume is going to rise, but the market is going to drop. In this point, right now, the volume is going to do what? The volume is going to rise. Coming at this point where like now you say, here's the volume. Okay, the volumes come to this point, this candlestick. So this candlestick at this point is giving you what? The demand. There is a demand of this candlestick. This is the demand. This candlestick at this point is this candlestick, which is the demand. But at this point is the resistance. Okay, now the market goes up, but the volume drops. The market closes, the market went up, the volume remains at the low. Now the market opens, the market went down, but the volume keep on rising. Right now the volume is low. At this point, once the market sells to this point, the volume is going to rise. Why does it rise? It rises back to this point, which is the highest volume, which is this candlestick. This candlestick, it is the volume of this candlestick. Easy as that. What is difficult? What is difficult is that you don't understand once the market touches inside this, the volume is so high. When you buy, you don't have enough money. Now with this, all of these things, you can combine and say there's a margin. A margin is calculated due to the volume. The volume of the market rises, you don't have enough money, the spread rises, it gives you the of course. During the news, when you close, the volume can still big, but inside this, regardless of the NFP, inside this, because inside this, there's no NFP, there's only the FOMC meeting and the Fed interest rate. If inside this, there's NFP, there's PPI, all of those session news, they will have small volume, regardless of how bigger is the candle, they will have a small volume. Why? Because that is moment the liquidity at this point, it is being synthetically. There's a synthetic volume in this point, meaning the candlestick, it is a synthetic candlestick, it is a synthetic NFP. You see? I said if I can talk, you won't listen to me. You'll be surprised why these guys know all these things. We know these things because of your mentor is not the same as your mentor. Me, I learned these things from the brokers. I paid a lot to learn of these things. A lot this year. I was like, wow. The volume can give you a resistance and a support. You can clearly know this candlestick was fake. And how can you know that this candlestick was fake? Because the volume is so less. Easy as that, okay? By the way, it's TGR. That is my first video analyzing the market for 20 minutes.